Half a century ago, an average family could purchase a home for $68,000. But today, that same property might command a price tag of $600,000. Three major structural changes quietly passed over the past 50 years systematically gutted the middle class. In 1971, governments began printing money without strict limits, causing widespread inflation while wages remained virtually flat. If wages had kept pace with economic productivity, the average worker today could have earned $92,000 a year instead of just $56,000. Furthermore, in 1978, the tax code was entirely flipped. The top earners saw their tax rates plummet from 70% to 28%, forcing the middle class to pick up the bill and drowning ordinary people in debt. In such a system, the only viable escape route is to invest aggressively into assets that inflate along with the rapidly expanding money supply. For a long time, traditional brokers charged massive commissions that essentially kept average, hard-working people entirely out of the financial markets. But the world is now living in the golden era of financial technology. During the global pandemic lockdowns of 2020, popular investment applications experienced record-breaking growth as millions of first-time traders opened new accounts. Robinhood reported 3 million new users in just the first quarter of 2020, while the UK-based platform Freetrade saw a six-fold customer increase, and the Israeli brokerage eToro grew its base by 40%. These online trading platforms significantly lowered the barriers to entry by providing direct, zero-commission access to global financial markets right from smartphones. However, this unprecedented access came with an intentionally engineered dark side. Fintech companies revolutionized personal investing, but faced heavy criticism for targeting young, inexperienced investors using gamification principles. These applications utilized confetti animations for trades and offered digital scratch-off lottery tickets for free stocks, making investing feel like a highly addictive video game. This deliberate manipulation pushed many young investors into high-risk options trading without fully understanding the devastating consequences. The dangers of gamified apps gained global attention following a tragic incident in June 2020, when a 20-year-old American amateur trader took his own life after wrongfully believing he had amassed $730,000 in debt from trading complex financial options. This technological revolution coincided perfectly with a massive social media-fueled investment hype. Social media platforms like YouTube, Instagram, Reddit, and TikTok became the primary sources of financial information for a younger generation, largely failed by traditional education systems, birthing a new breed of content creators known as financial influencers, or finfluencers. Behavioral models explain this adoption through perceived usefulness and ease of use. Social media offered quick, digestible financial summaries that were free and accessible. Yet, navigating this space required extreme caution. Many finfluencers recommended high-risk investments and pushed get-rich-quick schemes without possessing the proper financial education or licensing to give such advice. The chaotic power of social media influence was starkly witnessed during the GameStop short squeeze incident in January 2021. An online community on Reddit called Wall Street Bets created massive hype around the struggling video game retailer, influencing millions to aggressively buy its shares. Driven entirely by enthusiasm and a collective desire to bankrupt institutional hedge funds, the coordinated frenzy caused GameStop's share price to soar 20-fold in days, eventually leading to massive losses for latecomers when the bubble inevitably burst. In behavioral economics, this is known as herding behavior. Because the human brain cannot process the infinite amount of financial data available, insecure novice investors use mental shortcuts, blindly following the crowd without doing their own due diligence. This mentality fueled catastrophic bubbles, such as the Musk effect in early 2021, when Elon Musk's tweet sent the joke cryptocurrency Dogecoin soaring by 800% in a single day. This volatile environment created a fertile breeding ground for malicious cyber frauds. Scammers exploited the lack of regulation and the anonymity of the internet to orchestrate devastating scams, such as pump and dump operations in the cryptocurrency market. Fraudsters would buy massive amounts of an obscure digital asset at a low price, artificially inflate it through aggressive social media promotion by leveraging the fear of missing out, and then secretly dump their overvalued holdings. Studies indicate that perpetrators specifically target vulnerable demographics who lack digital literacy. To protect themselves, individuals must develop uncompromising digital literacy, recognizing that true experts display humility, acknowledge their mistakes, and encourage critical thinking rather than promising guaranteed returns. While the media heavily focused on retail stock market drama and crypto scams, an entirely different and potentially systemic risk was quietly building in the shadows: the explosive boom in the private credit market. Private credit involves direct lending by non-bank institutions to corporations through non-public loans. After the 2008 financial crisis, regulations like the Dodd-Frank Act prevented traditional banks from participating in highly speculative lending, allowing private credit funds to fill the void. Today, this market is estimated to be worth between 2 to 3 trillion US dollars. Institutional investors became obsessed with private credit because these loans offered higher yields and floating interest rates, which protected them when the Federal Reserve aggressively hiked rates in 2022 and 2023. Most dangerously, because these loans are completely private, funds are not legally required to mark to market. Unless a borrower officially defaults, fund managers can pretend the loan is perfectly fine, creating an artificial series of smooth returns that successfully hides the true underlying risk. This lack of transparency has masked signs of severe speculative excess. As assets under management tripled in just 5 years, private credit lenders negotiated against themselves, offering loans with incredibly loose covenants to highly risky, over-leveraged companies. Cracks are already showing. Major business development companies like Blue Owl called off internal fund mergers because underlying assets were deeply underwater. BlackRock saw a specific private bond marked perfectly at 100 cents on the dollar, shockingly written down to absolute zero in a matter of weeks. Elite institutions are also feeling the squeeze. Harvard University, despite a massive endowment, had to enter the public debt market with a $450 million bond sale just to cover operations because their capital was trapped in illiquid private assets. If the American consumer continues to weaken, a massive private credit bust could trigger severe losses for life insurance companies and cause a 20 to 30% correction in the broader stock market, especially if the current artificial intelligence bubble pops simultaneously. To protect against these looming crashes and finfluencer scams, investors must abandon the gambler's mindset and adopt rigorous fundamental analysis. Consider Microsoft, a technology behemoth with a market valuation exceeding $3 trillion. Microsoft boasts a staggering profit margin of 43%, a return on equity of 33%, and a debt-to-equity ratio of an incredibly healthy 0.12. Its Altman Z-score sits at an astonishing 9.6, indicating absolute safety from bankruptcy. The company's trailing 12 months revenue is actively accelerating due to aggressive investments in research and development. Despite its size, conservative valuation models flag Microsoft as fundamentally undervalued by about 5%. Contrast this with Spotify, which recently turned a net profit and boasts strong sales growth. While fundamentally sound, market pricing models reveal Spotify is currently overpriced by roughly 12%. And the company historically dilutes existing shareholders by issuing new shares to raise capital. A true investor knows that buying an excellent company is only wise when the mathematical odds are heavily stacked in their favor. The financial industry often sells the lie that such analysis is too complex for beginners, requiring Wall Street hedge fund managers. However, recent data proves this completely false. An independent analysis tracked the annual stock market returns of 16 average financial YouTubers. Astoundingly, 14 of these ordinary content creators completely beat the returns of the S&P 500 index. Creators like Asymmetric Investing achieved an incredible 42% return by identifying massively undervalued opportunities like Robinhood and Micron Technology. Ticker symbol U saw 37% returns by accurately predicting the AI boom and allocating into Palantir. The top performer, Business with Brian, achieved a staggering 57.6% annual return, boosted by a highly calculated risk on D-Wave Quantum, a stock that delivered a 211% gain. Conversely, the few who lost money were those who concentrated their portfolios into overhyped companies like Duolingo, which plummeted 45%. The ultimate lesson is profoundly empowering. The system is designed to keep the masses trapped, but technology has democratized the financial markets. One does not need to be rich to invest. One needs to invest to become rich. By conducting independent research, rejecting the emotional herd mentality of social media, and focusing on concrete mathematical fundamentals, ordinary individuals can routinely outperform Wall Street and build their own ladder to